this is Professor Harrigill. Today is Tuesday the 21st of January and it's about 10:30 in the morning Pacific time. I'm here in my home in Casa Grande, Arizona, and I just wanted to talk a little bit about some of the first week concepts, and they also roll over into the second week a little bit. Managerial finance can be a little bit overwhelming if you are not in the financial world, but I really want to encourage you, if you're feeling overwhelmed already, that although there's a lot of definitions and terms and stuff, if you really think about the concepts, it's going to make it easier, because the concepts just have to do with being able to manage your business and know the numbers, know what's making a profit for you, what's losing it for you. A good thing to look at is Shark Tank. If you've ever watched that show, you have somebody that has this great business idea, and they'll have a great product or concept, and they'll come and do a pitch, and the sharks will say, yeah, that's great, that's wonderful, now give me your numbers. And they'll get a blank stare, and then Kevin's going to crucify them because they didn't know their numbers. This class is kind of about, well, if you had a business or you work for a business, what are your numbers? What do the things tell you that will then allow you to take action to either increase the profits of your business or maybe save a failing business? So the concepts really make sense. Don't get lost in a book that really is pretty dry to read. But if you think about, well, if I had a business, how would I know these things? So that's what this thing's about. Managerial finance doesn't have to be a scary concept. Let's talk about the discussion for week one. And I'm going to, at the end, talk about the questions that were posed. But talked about shareholder wealth. But first of all, your original posts, I thought you all did very well. The replies, though, were a bit sparse in some areas. Make sure that in your original post you fully answered all the questions posed. But when you reply to your fellow students, don't just say, yeah, that was a good post, or I agree, or whatever. Add some depth to it. I agree, and here's why I agree, or I disagree because. Let's try to add new content to it. Then the assignment also calls out for a reference. You need to list at least one reference. Of course, everybody said, well, here's the book. And it's a little bit too easy to do the book. So from this point forward, I would like you to list at least one reference that's not the book. You want to reference the book, that's cool. But give us one reference that is something else. It's not going to be hard to find something else, but at least it'll give you a little bit of practice into finding other sources. Make sure it's an authentic source, though, and not just somebody's blog. Before we get into the specifics of the discussion, though, let's talk about the three main reports that are in the accounting world, and it's touched on in one of the first chapters, because these are the main reports that kind of everything else flows from. The first one is the balance sheet, the second one is the income statement, and the third one is the statement of cash flows. Balance sheet is a snapshot in time. It's not for the year, it's not for the quarter, it's for the end of business day on December 31st or June 30th. It's a snapshot in time, at this point in time, and it lists three things. Number one, what are my assets? What are the things that I own? The cash, the property, the equipment, all this stuff. What are my assets? Second thing, what are my liabilities? What are my accounts payable? What are my what's the debt that I have? Maybe it's a mortgage or a bond or whatever. But these are the things I own, these are the things I owe, my liabilities. Now you take the difference between those two, what do you have? You have equity, or owner's equity, as they say in the equation for accounting. Assets minus liabilities equals owner equity. So who owns that equity? It's going to be the owner of the company. If it's the company has sold stock, and that's what we're mostly talking about in this particular class, is it's going to be the shareholders of the company. So the second report is the income statement. The income statement says these are my revenues. These are my gross sales. This is what money came into my business. Then these are the money that came out of the business. The cost of goods, the cost of doing business, what I paid for my employees, what I paid for my electric bill, etc. And when you take your income and subtract your cost of doing business, that's going to give you your earnings. And we can sometimes call them profits. Earnings and profit, they're related, they're almost the same, they're technically different. But for the sake of this discussion, right now I'm just going to say earnings and profits, or we can use those terms synonymously. So income statement says this is what I earned during this period of time, and it's a time period. Then the statement of cash flows says this is where all my cash went, or this is where it came from. And cash is cash or cash equivalents, or something that has high liquidity. Liquidity says I can convert it to cash in a very short period of time. And typically for a business, that short period of time, I'm going to say, is 90 days. Because a 90-day bond, for example, 3-month bond is kind of what all the short-term interest rates are based on. So those are the three main reports. Make sure that you are familiar with those three reports. If you can be familiar with those three, you can look at just about any financial piece of information and know what they're talking about, and it'll make sense to you. So let's say you want to start a business and you need a lot of money to do that. You want to start making a product, but you can't afford to go out and buy the materials. You need some help. So how are you going to fund your business? Two main ways you could do that. One is debt, one is equity. Debt says I'm going to borrow money. I'm going to go to the bank and just take out a loan. I'm going to go to some investors and take out a loan. It's now I'm going to be owing money. The other way I can do it is equity. I can sell part of my business for money up front. Again, if you use that Shark Tank analogy, most of the time a person will give a pitch and they'll say, here's my idea, and if you give me $100,000, I'm going to give you 20% of my business. They're selling equity. And now, there's no debt. It's just that if they sold 20% of their equity, 1/5 of the business now belongs to that new investor who just paid that $100,000. That's what selling stock does too. When you sell stock, if let's say I'm going to sell 1 million shares at $10 each, I'm going to bring in $10 million. But each share now is worth 1/millionth of the company. And that is equity. So when you talk about equity markets, all you're talking about is the stock market. So debt and equity are the two ways that you can fund your business. So let's now focus on the equity piece. I have sold stock in my business. I've sold 1 million shares. I originally sold them for $10 a piece. Now I've got that, $10 million, and I'm growing my business. I'm starting to hopefully generate income. Typically, when an upstart company just gets off the ground, they're going to lose money for for a while. They might burn through that $10 million, in a relatively short amount of time, but eventually they're either going to go out of business or turn it around and start making a profit. And it's very common for an upstart company to start losing money at the very, very beginning, but then it grows. Amazon was a great example. Amazon, it's one of the most valuable companies today, but for years and years, they did business without ever turning any kind of profit. They had a loss quarter after quarter after quarter, but eventually they turned it around, and now they practically own the world. So, how much is a share worth then of a company? You could say, okay, well, let's take the value of the company, assets minus liabilities, and divide it by the number of shares out there, and that'll give us a share value. Well, that's a book price, but that's really not how the stock market values shares. Stock market values shares more than anything based on expectation of where this company is going in the future. That's why a company can sell shares in a business that is losing money, and it'll lose money for a very long time, and it keeps going up and up and up and up, the share value, yet they're still losing money. Because the expectation is that eventually that's going to turn around, as they're going to make a profit, and I've got ownership in something that is going to be bigger in the future. So the share value is actually more based on expectations of where the company is going. Then when you take the earnings that a company makes and you divide it by the number of shares that are out there, you get this thing called earnings per share. And earnings per share will essentially say that, for every share, let's say I make $20 million, and I've got 1 million shares out there. So now what's my earnings per share? 20. So that's a real simple ratio. But let's say you make $20 on a share. Well, is that good or is that bad? It depends on the price of your share. Right now, Amazon is at $1,800 a share. Is $20 good? No, it's spit, But if you get something like, Bristol Myers, that's only worth $65 a share, and they earn 20. That's huge. So, we take it one step further. When we get earnings per share, now we take the earning and we take the price, and we have a PE ratio, price over earnings, a ratio, price divided by earnings. And that just gives us a number. And that number is how is the value of the stock compared to the price, and now you can compare it with other companies that have a completely different share price. So let's take two pharmaceutical companies. Let's take Bristol Myers Squibb, and you take Johnson & Johnson, that are both in the same sector. Which one is a better value? Well, Johnson & Johnson, I think their stock price is up, 140 something, and Bristol Myers is 60 something. So you can't really compare the two. But if you do a ratio, if you compare the price over earnings, then you could say, okay, well, one's at 20 and one's at 25. And now all things equal, maybe the one who's 20 would be a better deal if you were purchasing stock. So the PE ratio just kind of tries to take stocks with different values and allows you to do apples to apples comparison as much as possible. Now, a company makes a profit. What can you do with that profit? There's three main things a company can do if they make a profit, if they have earnings. Retained earnings, what they can do, number one, is they can grow that company. And when they grow the company, they're going to create jobs, they're going to buy equipment that will create jobs and sales somewhere else. Maybe they're going to add a factory, maybe they're going to purchase land, they're going to hire new employees. That's good for the economy, that's good for everybody, and hopefully the fact that they're investing this money back into the company, that means they're going to be making more money in the future, so you're going to invest now to earn more later. So growing the business should be good for everybody. Research and development, all kinds of things you can do. The second thing you could do is you could start giving some of that money back to your investors. You do that typically in the form of dividends. And when a company first starts out, it's pretty rare for them to pay dividends because they need that money to invest back into the business to become profitable. But once a company becomes established and they start retaining earnings and their cash balance starts to grow, investors start thinking, well, we need a little bit of our money back. We need to start recouping our investment. So companies will start paying a dividend. Usually a company will pay a dividend quarterly. It's not always the case, but once a quarter they'll give you, X dollars or X cents per share that you own. And one of the measures of how a company is doing well over time is, can they maintain giving you that dividend over time, quarter to quarter to quarter, and can they grow that? If a company is consistently giving a dividend and that dividend is consistently going up over a period of time, that's usually a sign that the company is in a strong financial position. On the other hand, if a company starts going south, one of the first things that they may have to do is start cutting that dividend. And that's always a bad sign for Wall Street. So companies avoid that. Even Boeing right now, who's struggling, they could cut their dividend, but they've decided to instead keep that dividend going and instead sell some bond, take on a little bit of debt to get them through this current 737 MAX problem. The third thing that you could do is the company could take this cash, they could go out onto the stock market and buy some of their own stock back. And what happens there is that now they have fewer shares and their earnings are going to stay the same, but the number of shares is less. That means their earnings per share goes up. So it becomes a stronger stock for the shareholders. And it's just a good deal for everybody. So those are the three main things. So in our discussion this week, it talked about shareholder wealth. And in order to grow wealth as a shareholder, you've got to worry about the stock price and you have to worry about dividends. That means you have to have good earnings. And I want to distinguish between investing and trading stocks, okay? Because I've been an investor for a long time and I consider investing to be a long-term thing. I'm going to look for a good, solid company or a company that has good potential. I'm going to invest in it by buying some stock, and then over time, I want to either have it do capital appreciation, meaning the stock goes up in price. I will then have a capital gain, and the stock goes up, so I make money because the value of that stock's higher. The other way I can make money on the stock market is dividends. If I have a company that doesn't do much, the stock price stays pretty much the same year after year, but it's paying me 8 to 10% in dividends, I'm going to be happy with them because I'm still making an 8 or 10% return on my money. It's just not in the form of capital gains, it's in the form of dividends. So stockholder wealth to me has to do with having a good share value over a long period of time. That's opposed to trading. You hear about these stock traders, and if you've heard any talk radio, you hear these ads from like Online Trading Academy and stuff like that. They're not worried with the fundamentals. All these numbers that we're talking about in our books, we're going to call those the fundamentals of the company. A stock trader, on the other hand, is just worried about short-term news, because there's a lot of things that can move a market in the very, very short term. And what they're worried about, or what the traders want to do, is they want to take advantage of very short-term gains and losses in the stock market. So they might buy a stock in the morning if they think it's going to go up and sell it in the afternoon, or if they think a stock's going to go down, they'll sell it short in the morning and then buy it back later in the afternoon and make the profit on the downside. Trading and investing are two separate things, and don't mix them up, because there's not much a financial manager can do for the short term of his company. If the whole stock market is going down, it's going to be like the tide. They rises and falls, and all the boats go up and all the boats go down. And that's definitely true with the stock market. But what you want to do is do something that if the tide's going up, it'll go up farther, and when the tide is going down, it just won't go down as far. And who's able to do that? Well, for the most part, it's just the financial management. It's the management of the company that can really make those decisions that matter. Sometimes there are individuals that can do something extraordinary or totally screw up, then it makes a big difference to the company. What happened with Boeing in the 737? Was it just because a couple software engineers decided to take some shortcuts, or was it because management decided to take some shortcuts? I don't know. I'm not privy to that. But just know that shareholder wealth has to do with the stock price over a period of time. Profits, on the other hand, are more short term, and yeah, the price has to do with profits, but it isn't even so much how am I doing now, it's how am I going to do in the future. Netflix is a good example. End of market today, Netflix announces their earnings. And the market right now is on edge for Netflix, because they want to know how they did this past quarter, because they've gotten some more competition with Disney Plus. And how are they going to do next quarter, because they see a new streaming service, Peacock, coming in the very near future. So whatever Netflix does today, they're going to probably report a pretty decent profit. But the price of the stock is probably going to go up or down at the end of trading today, based not so much on how they did this past quarter, but rather on their projection for the coming quarter. And if they project the number of subscribers are going to either go down or level off, that stock is going to tank overnight, and it's going to be probably trading much less tomorrow. On the other hand, if their projection is, they can weather this Disney Plus thing, and their number of subscribers is going to go up, then the stock's probably going to rebound and go back up, because the expectation. So stock price, yeah, it's based on the fundamentals, but it's more expectation than anything else. So anyway, I rambled on way too long. I apologize for the length of this video, but I just want to put it in your mind that when you start thinking about the things that this class is teaching, if you are going to have anything to do with your own business or work anything financial in anybody's business, or maybe your church, because the church, even though we're there to worship God and evangelize, there are many churches that have failed because they haven't managed their finances properly. And just knowing the concepts of financial management, don't get lost in the minutia of the things that seem difficult. Worry about the concepts, and I think you're going to do great. Have a great rest of the class, and I will be getting out the discussion grades by end of day today, and hopefully I'll have the papers graded by tomorrow. And feel free to contact me if you have any questions or comments. So, have a great week all. See you later.